Hey, thanks for watching. Thanks for watching. It's Thursday, November 13th, and it's after the market close, so it's not quite lunchtime, but just for the consistency of bringing you hopefully helpful information. Welcome to Lunchtime Profits. This is Jeff Wright with Fish Creek Capital. I'm president and founder of Fish Creek Capital, where we love helping people with their investing journey and long-term cash flow plans, especially dividend growth portfolios. So what do we have going on today? Again, just trying to get out here for consistency's sake, learning how to talk better into a camera, learning how to speak more clearly and to bring you better information. Today was the worst day in the market in over a month. Looking at different screens here, the Dow was down 797 points at minus 1.65%. The S&P was minus 1.66%. And then the NASDAQ was down minus 2.29%. The Russell was 2.77. So it had the biggest drop, but had a little, I guess, sell the news on the government shutdown from success and approval from yesterday. So I was looking just to see what other headlines are here. Technology stocks, a lot of the AI names did get beat up. CoreWeave was one of those. Again, like I think that's hopefully something I can communicate in these videos, is that it really matters what you invest in, that the real companies that produce real cash flow and have real earnings. It's just not, hoping or guessing or trying to time some kind of momentum stock. In the short term, you could do well with that, but you can't often people don't do well with that over the long term. And so like these stocks, they ran up, but you don't know how long it's going to last. You don't know. And when they drop hard. It's just not sustainable. So don't do that. Like I've tried to do that. I started investing in trading really in 1997, did a lot of trading in 2008, and I've done futures. I've done, of course, options, technical analysis. Like you just don't, that's not a good plan. So I want to help you with a good plan of long-term success in the market. You can't ignore the success of the market because it's averaged 10% growth. That's better than real estate. That's better than a lot of other assets. So you've got to have exposure to the stock market, but you've got to have a clear, defined plan. And then you got to have the discipline to stick with it. And that's what I want to help you with, especially with the cash flow that you can create out of the stock market. So anyways, I guess kind of got off on that for a minute. And one of the things I was going to try to do, I think I can, let's see if I can share my screen. Let's see if this is still going. We're going to do entire screen. Let's see. Yeah, I think we're still going here. You should see behind me a screen. This is a screen of the S&P. And I thought I just would kind of show you real quickly. So today, let's go back to like an hourly chart. This is the S&P 500. And yeah, you can see that it was just down all day. And then at the end of the day, we tried to bounce a little bit. This is an hourly chart, but where does it put us in the bigger time frames? Hopefully this is updating fast enough. So this is a daily chart. We've got this bottom back in April from the tariff announcements, and man, we've been grinding higher. There was a big dip in October, and it just got bought up, and then now we've come back down and have another red candle here. So this seasonally, November through February, March is the best time for the market based on history and seasonality. But we're not, so far in November hasn't really been that great. So we'll see what happens this year. on the weekly basis, again, you can just see we're still in that uptrend, very much so. Let's see, the moving averages. So you've got like the line there, that kind of orange line, and then that blue line. That is the 8-day and then the 10-day there. So we're right above, like we want to keep holding those. You can see these candles have stayed above those two lines basically all the way, well, since April, so since the tariff. So if we start breaking below these, so that 67.20 level, that could lead to more downside. But again, you don't want to try to time the market. We really don't know what's going to happen, right? You can't tell, so you want to have a good solid plan. And I was talking with a client. Let's see if I can share this. This is a sample portfolio behind me of just kind of a blend of growth and dividends and dividend growth. And so if what we were talking about on this portfolio is, frankly, it has not performed as well over the year as the indices are weighted, markets like, so the S&P, that'd be like the SPY, or the Qs with the NASDAQ, because of the weightings of those indexes, heavily into technology. They have done well this year, but the long-term thinking and plan that I'm talking about is thinking about these businesses as an owner, so if you combine growth with dividends, this is what it can look like. So this is just a sample portfolio. There's 23 different companies or ETFs represented here. Amazon, we've got technology, Microsoft, the Qs are in there, so that would be the NASDAQ, JP Morgan with the banks. This is just a sample. This is not recommended. This is not investment advice. This is for entertainment purposes only. But let me move a little faster. I'd like to end this. So you can see, though, what I've got here is the yield, and then the growth of the yield. This is key, the growth of that yield. And this is a 10-year history. Some things you won't see because, like, Amazon doesn't have any dividends. That ETHA is actually an Ethereum ETF, and so they don't have any dividends. That's highly speculative there. But Microsoft does pay a dividend. The Qs actually do pay a dividend, and they've grown that dividend 9.45% over the last 10 years. But what's kind of neat is look at FedEx here, 2.15% on the yield right now. That you could say, well, that's not a good yield. And that is a lower yield, but look at the growth. That growth over the last 10 years, they've averaged 20% growth on that yield. JP Morgan has averaged 12.69%. Starbucks has averaged 14%. Starbucks has the new CEO. The CEO came over from Chipotle, and he did tremendous things at Chipotle. So now he's at Starbucks. So something to think about. Look at Constellation Brands, 15.9%. That's how much they've grown their dividend annualized over the last 10 years. TPL is the largest landowner in Texas, in the state of Texas. They own the most land in the state of Texas. They have a very small dividend, but they've grown it 50% annualized over the last 10 years each year. Visa, 17%. So when you take this is how you got to think. So if you average all this out, even with the companies that don't pay a dividend, we have a 2.55% average yield with an average 10-year growth of that yield of 9.29%. So let's put that into a calculator, and forgive me here. Let's see if you can see this. This is Fish Creek Capital. I don't have this showing yet on our website. We're working on that. And again, this is just for educational purposes only. This is not investment advice. But let's say you take a $500,000 portfolio with that portfolio, that $500,000 investment with that portfolio. Say you don't add anything to it, but you take the 2.55% yield with a 9% growth, and do that over the next 10 years. We're going to reinvest the dividends. Look, the balance, $739,000, annual dividends of $40,000 a year. You've got a yield on that cost of 8.1%. So that's how you're going to beat the market. So and that's not counting any growth in these actual stocks. Like, so the Amazon, like the company that's in that portfolio that doesn't pay a dividend, but they're going to grow over the next 10 years, right? Like they have tremendous cash flow. They have great management. It's going to grow. And so you're not factoring in the growth of those stocks. But if you just take that portfolio, even after 10 years, you're going to have an annual income that's not touching your principal of $40,000 a year, 8.1% a year just in dividends alone on that return. So that, guys, that's how you beat the market. That's how you create generational wealth. That's how you create cash flow predictably and safely, compared to just investing in AI stocks that can, cause the market to go down. What did we say? What was it? The NASDAQ down, 2.22% today, just, on a random Thursday, all the fear that created. But in this scenario, you don't have to worry because you know the plan and you can predictably kind of figure out what's going to happen. And it's peace of mind. So guys, again, educational purposes only. This is not investment advice, but I want you to think about like what this looks like and just the mindset of how to invest in the stock market. And this is the mindset you take. So we'll end there today. Again, late on the lunchtime, but hopefully that was helpful, and we'll see you tomorrow.